Trillions in corporate debt need to be refinanced by 2027 at rates that are effectively double what these companies originally borrowed at. If your SRS is heavy in high-yield bond funds or over-leveraged REITs, your retirement cash flow is sitting on a fault line right now. I have been running these numbers on my own deployment for weeks. When I looked at the sectoral gearing averages for industrial REITs, I stopped and recalculated everything from scratch. This is not a drill. This is a slow grinding of capital that catches you when you stop paying attention. Let us look at exactly what is sitting on that fault line. The era of cheap refinancing is dead. The 2027 debt wall is going to be the graveyard for companies that failed to term out their liabilities when money was free. This is not a sudden 1997 style collapse. There is no overnight liquidity crisis coming. What we are watching is a slow motion grinding of capital companies that gorged on cheap money, now face interest costs eating up half of their operating cash flow. This is the debt supercycle reaching its inevitable mathematical conclusion. The data shows a very distinct divergence across global and local macro indicators. Our local banks are absolute fortresses, with common equity Tier 1 ratios near 14.9% that clears the Basel III benchmark easily. The Straits Times Index earnings yield of 7.2% also clears our minimum hurdle with room to spare. But the yield-generating assets inside most SRS portfolios, specifically REITs and bond funds, are actively breaching my forensic safety thresholds at the sector level. Global corporate default forecasts have hit 3.75%. Singapore industrial REIT gearing is sitting at a concerning 38.2%. Here is where the forensic limit becomes clear. The sectoral gearing average for industrial REITs has climbed to 38.2% against the broad sector average nearing 40%. That is 320 basis points above my 35% fortress balance sheet ceiling, and significantly higher than the 31.5% average we saw during the free hike era. While Capital and Ascendas REIT maintains a relatively disciplined profile, several mid-cap industrial players are flirting with the 42% danger zone. At 42% gearing, the buffer against any valuation write-down in a risk-off environment is heavily reduced. And here is the wallet impact. In a forward scenario where global growth undershoots by 0.5 percentage points and credit spreads widen by 50 basis points, interest costs for these REITs would rise by an estimated 12%. That likely produces an 8% distribution per unit contraction for any REIT with more than 30% of its debt maturing before 2027. A 10% cut in distributions from industrial REIT holdings translates to roughly $150 less in monthly spending power for a 62-year-old in Toa Payoh. For that investor, these high leverage counters have moved out of the sanctuary and triggered a direct watchlist alert. One number anchors our entire strategy. My forensic floor is 3.2%. The 6-month Treasury bill currently sits lower at 1.45%, but I never lower my standards to match a temporary market dip. The floor holds at 3.2% to ensure sanctuary assets can withstand a return to long-term average interest rates. Add the mandatory 150 basis points of risk premium, and the absolute minimum yield hurdle is 4.7%. Any income asset yielding below 4.7% is simply not compensating you for the risk you are carrying right now. The real risk is not necessarily a localized default, it is a global credit drawdown. When global insolvencies spike, and Standard & Poor's is now projecting 3.75% for the speculative grade universe, risk premia get repriced everywhere. That hits your bond funds directly through net asset value mark-to-market losses. It hits your REITs through higher funding costs that compress distributable income. The signal is already flashing in the United States, where high yield spreads are running at 6.6%. The market is demanding significantly more compensation for debt risk than the 5-year average of 4.5%. We cannot ignore that repricing. And let's be honest, many investors think they are safe because they hold diversified bond funds in their SRS. Diversification into poor quality debt during a default cycle is just a slower way to lose your money. If a fund manager is chasing 7% yields in an environment where the risk-free rate is elevated, they are likely holding paper that will be the first to burn when the 2027 debt wall arrives. Real safety comes from capital structure, not from owning 1,000 different names. In a debt supercycle, prioritizing capital preservation over a headline distribution number is not a conservative choice. It is the only rational one. Singapore banks sit in a strong position, low default risk, narrow forensic gaps, highly resilient. Prime industrial REITs show medium sensitivity, with high occupancy buffers providing some cushion. Cyclical retail REITs face high interest sensitivity and heavy refinancing pressure that directly squeezes distributions. Global high-yield bonds are in the critical zone, massive refinancing pressure, high default risk, and the conditions for spread expansion are building. You have to know exactly which sector your capital is sitting in before the cycle turns. Iggy's elite investors already have access to the fully downloadable stress test worksheet. If you want the forensic tools to audit your own holdings before the market reprices them, 0-day access is available right now through the link in the description. Step 1 of this stress test is to inventory your leverage. You do not need an expensive terminal for this, just 30 minutes and a spreadsheet. List every position in your SRS. For every REIT, check the gearing ratio. Above 35% market yellow, above 40% market red. Elevated risk and potential default danger in our 2027 scenario. For your bond funds, check the credit quality breakdown. Anything with meaningful exposure below investment grade is a potential default risk you need to isolate immediately. Step 2 is to apply a realistic haircut to your projected income. Run a moderate stress scenario on every single position you just marked. For every red marked asset, assume your distributions drop by 20%. For every yellow asset, assume a 10% drop. This is not being overly pessimistic. This reflects the basic reality of higher refinancing costs compressing distributable income before a single cent ever reaches your pocket. You need to see exactly what your cash flow looks like when the debt wall forces these companies to divert revenue to their lenders instead of their unit holders. The final step is the integration test with your central provident fund. Take your newly stressed, post-haircut SRS income and add it to your projected CPF Life monthly payout. Compare that combined figure against your basic monthly expenses plus a 15% margin for inflation. If that combined total does not cover your essential living costs, your portfolio is not the sanctuary you thought it was. It is a yield trap waiting to be sprung. You have to run this calculation now, while you still have the time and liquidity to restructure. Think of it this way. If your favorite hawker stall owner takes a massive loan to renovate, but the number of people buying his chicken rice stays exactly the same, eventually he has no choice but to raise prices or close down. Many companies are in exactly that position today. They rebuilt their balance sheets with cheap debt, and now the interest bills are coming due while global growth is slowing. The 2027 debt wall is not a wild prediction. It is already hard-coded into the refinancing calendars of thousands of companies. Cash flow must cover interest payments first. Do not let their poor planning become your personal retirement shortfall. Based on my personal tracking of global insolvency data and the maturity profiles of major sectors, any SRS portfolio heavily weighted in high-leverage REITs and bond funds is an immediate watchlist trigger. The math does not lie. The 2027 debt wall is a mathematical certainty embedded in published refinancing calendars. For a 62-year-old in bedrock transitioning to the drawdown phase, the stakes are critical. Ignoring this stress test risks permanent capital loss right when you need the liquidity the most. A 20% drop in your portfolio value just as you begin your withdrawal phase can take years to recover from, even if markets eventually bounce back. You are fighting the rising cost of living on one side and shrinking distribution checks on the other. If your portfolio only holds up when interest rates return to 1%, you are gambling on a past that is not coming back. United States 10-year yields holding at 4.26% have a massive gravitational pull on every asset class. Respect that metric. The only defense is to build fortress balance sheets. We audit for the storm assets that do not break under pressure. Look for Singapore banks with common equity Tier 1 ratios above 14.9%. Look for REITs that have already termed out their debt into 2028 and beyond. These are the defensive assets that will deliver the income you need when the global credit cycle turns cold. Sanctuaries are built during the calm, they are never built during the flood. The window to make these changes is still open, but the clock is ticking. Portfolio hygiene must happen today, before the 2027 debt wall arrives and the broader market starts dumping toxic assets. You need to act before the market opens, not after it has already moved and repriced your holdings downward. If you wait for the mainstream headlines to tell you the default cycle has started, you will be the exit liquidity for institutional money. The difference between holding a genuine sanctuary asset and holding a yield trap is often decided in a single, volatile trading session. Institutional investors hunt in packs and share data. Retail investors need to start doing exactly the same. You need a network of people who are cross-checking the next setup together in real time, so you never miss a critical detail. This debt wall is going to separate the disciplined investors from the yield chasers over the next 3 years. Your SRS was meant to be your safety net. Do not let someone else's over-leveraged balance sheet tear a hole in it. This debt wall is going to separate the disciplined investors from the yield chasers over the next 3 years. Your SRS was meant to be your safety net. Do not let someone else's over-leveraged balance sheet tear a hole in it. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. Do not wait for the 7-day embargo window to lift while the market actively reprices these over-leveraged assets. Join Iggy's elite investors to get the complete red zone watch list before the market opens, directly through the link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a licensed financial advisor before committing funds.